I am recording this early Monday morning, long before the US markets even open. And if you're watching this later in the day, you need to understand something very clearly. What happened overnight is not normal. This is not just another move. This is not just volatility. And this is not something you ignore and come back to later. Silver just traded at $70. And that was never supposed to happen like this. Not suddenly, not quietly, and definitely not before the US session even began. If you think this is just hype, slow down for a moment, because the most important part of this move is not the number, it's how the system reacted to it. Right now, there's a price split that should not exist in a functioning global market. In the US overnight session, silver is trading around $69.60. In Shanghai, silver is printing $70.15. That is a 55-cent arbitrage gap. And for anyone who understands metals markets, that should immediately set off alarms. Because gaps like that are supposed to close almost instantly. Traders buy the cheaper market, they sell the more expensive one, and the price snaps back into line. That's how global pricing stays synchronized. That's how the system is supposed to work. But this time, it didn't. The gap stayed open. And that's where the real story begins. Because when arbitrage fails, it's not because traders forgot how to trade. It fails because something is blocking the flow. Either physical metal isn't moving, or risk desks are frozen, or someone very large does not want to be on the wrong side of this trade. And every one of those explanations points to stress. Real stress. This is not about charts. This is about confidence. For years, silver pricing has relied on paper markets, futures contracts, derivatives, synthetic supply that exists only on balance sheets. Far more silver has been sold on paper than exists in vaults. And that system works only as long as nobody demands delivery at scale. But lately, that assumption has been breaking down. Industrial demand hasn't slowed, green energy hasn't slowed, defense demand hasn't slowed, and investor interest is quietly coming back. Silver is not optional in modern technology. It's critical. Solar panels do not function without it. Electric vehicles rely on it. Missile guidance systems use it. Satellites depend on it. Medical equipment requires it. There's no substitute that works at scale. So when silver becomes scarce, you don't just see higher prices. You see stress ripple through entire systems. And that's why silver is managed more aggressively than most people realize. Because silver doesn't just reflect inflation or speculation. It reflects industrial reality. And industrial reality is not negotiable. Now think about the timing of this move. This didn't happen during peak US trading hours. It happened overnight, when liquidity is thin, when the system can't hide behind volume, when pressure leaks out instead of being absorbed. That's when you see the truth. The truth is that something didn't balance. Someone didn't step in. Someone didn't sell. And that's a problem. Because markets are built on the assumption that there is always a seller. When sellers disappear, price doesn't drift. It jumps. That's how squeezes begin. And I want to be very careful here. I'm not saying this is already a confirmed squeeze, but the conditions are lining up in a way that should make anyone paying attention extremely uncomfortable. Geographic price divergence, physical tightness, paper confidence thinning. This is the same setup that has preceded major dislocations in the past. And here's what most people don't understand. Silver doesn't move alone. When silver breaks, it exposes pressure elsewhere, in currencies, in bonds, in energy markets, and supply chains. Because silver sits at the intersection of money and industry. That's why it's dangerous. Gold can rise without breaking systems. Silver cannot. Silver is small, tight, and essential. There is no margin for error. That's why $70 matters. Not as a target, but as a psychological line. Once people see silver trade there, something changes. Procurement departments panic quietly. Hedging strategies get rewritten. Risk models start failing. And failing models are how real crises start. Not with headlines, with spreadsheets that no longer make sense. Now ask yourself this. If everything is fine, why hasn't this gap closed? Why hasn't the system done what it has done for decades? Why is silver being allowed to print different prices in different parts of the world? Because the answer is not comforting. It suggests that physical constraints are starting to matter more than paper promises. And when that happens, control weakens. This is why institutions fear silver. Because silver forces truth, you can't print it. You can't replace it easily, and you can't scale supply quickly. Mining takes years, refining takes time, logistics take coordination. You can't fix a silver shortage with a press release. Now consider what happens next. When the US market opens, decisions have to be made. Do you close the gap aggressively? That requires metal. Do you suppress price? That drains inventories faster. Do you let it run? That draws attention. And attention is dangerous. Because attention brings investors. And investors ask uncomfortable questions. They ask about delivery. They ask about inventory levels. They ask about exposure. And those are the questions the system does not like. This is why moves like this are often followed by sudden rule changes, margin adjustments, position limits, Temporary measures, not because of volatility, but because of risk. And risk right now is asymmetric. There is far more upside pressure than downside flexibility. That's what makes the situation unstable. Now let me say this clearly. I'm not telling you to buy silver. I'm not telling you to sell silver. I'm telling you to watch it closely, because moments like this don't happen often. And when they do, they are usually dismissed at first. People call them noise. They say the market will normalize, and sometimes it does, but sometimes it doesn't. And when it doesn't, the adjustment is violent. The most dangerous thing you can do right now is assume this will resolve quietly, because quiet resolution requires cooperation, and cooperation requires confidence. And confidence is exactly what is being tested. Overnight gaps like this are warnings. They are signals that the system is under more strain than it wants to admit. And strain always shows up first at the edges, in off-hours trading, in regional pricing, in metals that are small but critical. Silver is one of those metals. If this move fades quickly, then the system absorbed it. But if it doesn't, if the gap persists, if prices hold, if sellers stay scarce, then what you're seeing is not a spike. It's a transition, a shift from assumption to reality. Silver at $70 was not supposed to happen like this, and the fact that it did tells you something important. Something behind the scenes is no longer working the way it used to. The next few hours matter. Not because of headlines, but because of reactions. Watch what the market does, not what it says, because markets speak in price. And right now, silver is saying something very uncomfortable. Something just broke behind the scenes, and we're about to find out how deep that break really is.